Hello everyone. Thank you for joining us. We have people from all over APAC today here with us, more than 100 at the moment. So I would like to welcome all of you to this webinar on trading technologies in Israel, co-organized by the Israeli Ministry of Economy and Industry and Israeli Securities Authority, and with partnership with Data Science Group. So my name is Yoav. I'm the head of the Israeli Economic and Trade Mission to Singapore. Let me go over with you guys a little bit on the structure of the event today. One second. So here's the agenda today. Here's the sequence of the speakers. One thing about the Q&A part, I want you to know that you have a small icon for the Q&A. All the participants in this webinar can ask questions as the speakers speak. And then after the speakers will finish their talk, they can reply to you on the same window of the Q&A. So feel free to ask questions during all the webinar. So this webinar was arranged by the Israeli Ministry of Trade and Industry, as I mentioned. So we have trade missions from all over APAC working on this event and brought guests from their own countries. So we have Mrs. Noah Sher from Japan, Mr. Shai Zarivat from Australia, Mr. Tzli Lahav from Taiwan, Yaniv Goldberg from South Korea, Barak Granot from Delhi, Esther Peretz-Burg from Hong Kong, Yaniv Tessel from Vietnam, Dagan Aloni from Thailand, and Yair Albin from Beijing. So without further ado, I would like to start with our first speaker. First speaker today is Mrs. Anat Guetta. She is the chairwoman of the Israeli Securities Authority. So Anat, you can start.
Okay, thank you, Yoav. Hello, everyone. Good morning and afternoon, Asia and Australia participants. And maybe it's a morning or afternoon, depending on where you are in the world right now. It is exciting for me to be here this morning. And I would like to start by welcoming my colleague, Mr. Muthu Krishnan Ramaswamy, our host, the Data Science Group, Yoav Seidel from the Singapore Trading Mission, all trade missions representatives from Asia and Australia, and all you dear participants. So I'm going to present you during the next few minutes our vision of open finance that is going to start up here in Israel very soon. I'll share with you the presentation just in case, sorry. Sorry, in a moment. Sorry, just a minute. I'm trying. Do you see the screen?
Yeah, we do, Anat.
Okay, great. Okay. So I'm going to present you during the next few minutes our vision of open finance that is going to start up in Israel very soon, as I mentioned before, and I will talk briefly about the regulation and the opportunities embedded in the Israeli capital market. And then I'll flick through a few slides that will give you an idea of where we stand in the global landscape, economically wise. I will also tell you about our unique dual listing arrangements and the exceptional public debt market that we have here in Israel that has grown up and provides attractive ecosystem for issuers and investors as well. And of course, if any one of you would like to have a deeper explanation about anything I'll mention, don't hesitate to use the chat facility on your screen, and I'll endeavor to answer at the end of my speech. So I would like to start with the hot topics that we have today. So the ISA is leading today two strategic processes, which are part of a strategic plan to enhance financial innovation in the Israeli capital market. The first strategic process is to lead the open finance vision, as we call it, together with our colleagues, regulators, in order to build a well-connected and a much more efficient financial market in order to maximize value for our customers. The ISA are going to be part of the open banking reform that should start up soon in Israel, that is going to be first inside the banking system, and then in stages will include additional parts of the financial system, such as insurance companies, brokers, and other market players. The focus of the reform is based on the principle that the information of the customer belongs to him, and thus he has the power to decide with whom to share it, just in order to get a better value proposition. And this, we believe, will lead for a much more customer-centric attitude that will be supervised by us in the future during the licensing process of the fintechs that will have to choose if they want to be a data providers in this API new market. So it is going to be a very new market that will be built on a wholly new regulatory framework that we are currently establishing. Well, as some of you may know, in the last 2 years, we had a long election period here in Israel. And in between, we as a regulator have led our own initiatives to support innovation in the Israeli capital market, such as establishing the FinTech Hub, using RegTech in our supervisory and enforcement activity, and starting up the foundations for the regulatory sandbox. The ISA was the first regulator in Israel and even in the world that has successfully implemented blockchain technology in its main informational system. In addition, today we are going to start a dedicated legislation process that I hope by the end of 2020 will put the foundations for the future digital markets. Israel has a great potential in its renewable primary markets. Over the last 20 years, Israel has built a reputation as one of the most innovative and technological advanced countries in the world. We have named the startup nation and enjoyed the reputation as a global leader in many advanced technologies. Our continuous growth attracts investment from all over the world and creates new markets. Primary markets are vital by bringing together investors who seek investment opportunities and issuers who seek to access capital funds to finance their businesses. And it is our commitment to make sure that our primary markets will work well in order to meet both these needs. Building smart markets for a smart nation is our objective. Innovation has gathered pace, and digital transformation is reflected in the new products finding the ways directly to investors and customers enabled by those digital markets. We do support innovation through our FinTech Hub that I mentioned before, through diverse innovation platforms for FinTech companies that we operate. And this is the reason why we have joined the GFIN, which is the global sandbox, which was established by the FCA, in which innovative firms can test their products in multiple jurisdictions while minimizing the time to market costs. Our main efforts these days are focused on shaping a holistic regulatory architecture to support the establishment of a digital ecosystem here in Israel. We aim to build a dynamic regulatory regime to support the safe activities of the new digital financial market infrastructure that the new era is offering us. And for instance, like tokenized assets, digital primary or secondary exchanges, or a digital integrated platform, wholly or partially. We hope that those infrastructures will provide the growing needs for funding and liquidity for the Israeli technology sector, and therefore, instead for looking for capital in foreign markets as we see today, Israel capital markets will provide the tech sector a tech-based solution here in Israel. We would like to build here in Israel the future capital markets of 2030, so digital platforms which are global in nature, from the opportunity for both Israel and the global investment community to enjoy the benefits that the Israeli economy holds in store. And I will go back to the numbers, and I would like to go over the strengthiness of the Israeli economy. So as you know, and you can see the figures on the slide, we have an impressive economic statistics also in relation to the global stats. We are a part of a prestigious club of the well-developed countries, sharing a good place in the leading global financial organization as well. We have a stable, growing economy that is reflected by numbers, and although a size, we have a very promising economic growth story. Looking at the Israel tech ecosystem, we can see that we have a very vibrant tech ecosystem comparing our size, with a large area of technological innovation and many fascinating unicorns. And here you can see the list that I'm sure you are well known of. And looking at the list, raise the question if you realize that some of the coolest fintechs in the world are Israeli companies. It is clear that the value creation potential Israel produced is exceptional in any figure. So going back to the Israeli capital market, and some stats on it will show that it is unique in two main aspects. The first one is our fixed income market that is open to retail, something that is unique comparing to foreign markets. It provides liquidity since it's being quoted on a base of mark-to-market basis, not like many other debt markets that are quoted on an OTC basis. Looking at the Israel bond market will show that it has grown rapidly at the last 20 years. Well, today we can see that the non-banking corporate lending activity in the capital market has surpassed the banking corporate lending activity, which means that the debt market in Israel become much larger. And there are opportunities for international debt issuers, which are mainly concentrated due to its liquidity, the trading method that I mentioned before, which is mark-to-market, that is direct involvement of retail investors, which is accompanied by an advanced, transparent legal system. The Israel debt market proposes an attractive market conditions for global debt issuers and surely for our local ones. The other unique aspect in the Israeli capital market is the dual listing markets, which despite a small size, Israel is currently the second largest exporter of companies which are publicly traded and listed in foreign primary markets, especially in American stock exchanges like NASDAQ, which is surpassed only by China. We have built over the last 20 years agreements with 6 leading exchanges. Lately, we've added Hong Kong, Singapore, and Toronto to the list of those prestigious exchanges. Those agreements actually offer higher value proposition for current and potential issuers. Looking at the size and volume of dual listing activity in Tel Aviv Stock Exchange shows that the numbers of dual listing activity constitutes a considerable size of market cap of issuers who chooses to exercise the option that our market proposed them for free. And the benefits of dual listing are mainly, first, looking for the main benefit, which consists of growing and diversifying the base of investors, potential to be included in leading indices, and being exposed to diverse trading hours, which could be a value for investors and issuers as well. We believe that the Israeli capital market should be grown to be a global market, and thus our efforts are intended to create a best global standards approach. And this approach is reflected in terms of reporting standards, having a potential to be included in global indices, encouraging global players to enter into our market, like rating agencies, underwriters, issuers, investment companies, institutional investors, etc. And we as a regulator, we are focusing on the concept of viewing regulation as a service to all market players. And it's based on our view that regulation is ultimately a license to do business. And by providing good regulation, we aim to encourage new businesses to be created. And those businesses are the backbone that support a growth of our economy. So thank you very much. And I wish you a productive webinar, and I hope that I stand with the time.
Thank you so much, Anat.
To you.
So let's continue. Our next speaker is Mr. Ramu Ramaswamy from Singapore. Ramu was up not until too long ago the president of the Singapore Stock Exchange, and now he's a board member at GovTech, NUHS, JTC Corporation, and advisor to Quantix.ai in Singapore. So Ramu, the floor is yours.
Thank you, Yoav, and good afternoon, everybody, or good morning, good afternoon. As Chairperson Anat talked about the Israeli markets, I'm going to spend the next 10 minutes talking about use of technology in a global market perspective, regardless of the market that you operate in, and where that's coming from and where we think it's going to in a broad sense. And hopefully with that, it acts as a background to the next several presentations that you're going to hear on the application of specific parts of technology into each of these areas where it is used in capital markets. Now, technology has always played a big part in the development of all kinds of capital markets. And there are 5 or 6 distinct areas in which technology is used, and they really follow the trade cycle. The first thing that you need to do when you're going to participate in a market is make a choice on what you're going to buy or what you're going to sell. And there is a whole lot of decision science and what you would call a pre-trade portfolio research, things which you do to decide what asset classes, what instrument, what company, whatever investment you want to make. Once you've made the choice of what you want to buy or sell, then there is a whole piece which is the execution, where you get best price execution or execution without having the market slip in terms of price, dicing your order into small bits so that you don't move the market when you execute a big position, all those which are around managing the actual execution of the trade and the various order management systems that help you do that. Once you've done a trade, then it's about managing your position post-trade, which is ensuring that the settlement happens on time, that you are parting with money only when you've got the goods you bought or the other way around, and managing your position. And then once you've done that and you've got a portfolio, then it's about managing the risk in your portfolio, which is evaluating your portfolios, either gains or losses based on things that are happening in the market that affect your holdings. And then the last part is performance analytics, which says how did you do relative to the rest of the marketplace, relative to the rest of the participants. And each one of these has a feedback loop that plays back into the earlier part of the chain. So your performance analytics, your portfolio risk management have a big role to play in your decision science and how you decide on what you will invest in. So technology has over the last several years developed in each one of these aspects. And it's come from, if I take the last 30 or 40 years, a lot of original thought went into taking a long time to build a portfolio of specific stocks or assets you would own. So those were the days when analysts were the kings. You kind of depended on an analyst to build a position book that you wanted. And that's how mutual funds and investment funds built up, which was people bought long only. They held it for long periods of time. The real skill was in choosing the right stocks to buy or the right asset classes to buy or the right countries to invest in. from there, as technology developed, people realized that you need not hold things for so long. If you got a signal that would help you trade with more frequency, but would help you kind of stay ahead of the rest of the market, you could make as much money or more money. And that's how slowly but steadily the high frequency trading models took on and hedge funds evolved. So these high frequency trading models really depended on a narrow signal coming out of either one of two things, either orders flowing into an exchange or an execution venue, or trades happening across multiple exchange venues. So your ability to process these in record time and then act on these to either buy or sell helped what you would call the high frequency traders to kind of remain ahead of the markets and make money. So this was a phase of development that took over 10 years. Most of the development was in three areas. One was in the speed of the analytics and the ability to execute. The second was in the speed of the data streams that you got out of exchanges or out of other sources of data that you could use, and then how you process those. And that's what led to things like co-location with exchanges, where more and more of the analytical engines were co-located right next to a execution venue within an exchange's data center, and everyone was into being right next to the exchange so that they could execute the fastest. The key here was that you depended on a very narrow stream of intelligence and a very high speed of processing. Now, slowly, that has two limitations. One is the physical speed at which data can move, and that's what co-location tried to address. And the second is what you would call the speed at which you could process it and then kind of come out with either buy or sell instructions, and then the exchange, the ability to execute on that. And so that's where, microsecond orders, and then now, milliseconds move to microseconds, and now people are talking about nanosecond-based capability to order. So slowly that hits a limit in terms of how fast you can go. And that automatically leads you to a place where you don't want to act so fast on so narrow a set of signals, but you want a broader set of signals on which you can act, where the holding periods can become a little longer. So these are no more holding periods in the order of hours or minutes, but are now days or weeks. And so more and more of the hedge funds and more of what were traditionally non-position taking organizations are now trying to use a broader set of signals and take a position that they manage within a few hours to a few days. Now that's where the development of AI and the ability to process a wide array of signals and then use that to take a position and then equally to liquidate a position becomes more and more important and more possible. Now, if you go back 30 years, a very good analyst was one who would be able to look at a wide variety of soft factors that affected individual stocks. And based on that research, as well as research around a specific stock, came up with recommendations about what you buy, where you invest, what you hold. Now, the human mind's ability to analyze at speed a large number of signals is limited. You do need time to assimilate, you do need time to create these models. Now, as these models are created and they become more and more self-learning and self-developing, then you are at a situation where the number of soft signals or the number of signals that you can process in a given time is constantly increasing. So I would say that we are now entering an age where you're going to see an exponential growth in the number of signals that can be processed within a unit time, and therefore the ability to act on those. This leads to what I would call an enormous ability to act across markets. People traditionally transacted in stock markets or fixed income markets or commodities markets, whereas now you're going to see the ability to operate across these markets from a single asset manager. So it is this ability to take signals that come out of these diverse marketplaces, FX, fixed income, commodities, stock, as well as general economic data plus political data plus emotional and sentimental data, synthesize all of those and translate that into trading signals on which you can act becomes the next holy grail that everyone's searching for. And I think it is in this arena that there are a number of interesting startups, particularly in Israel. And of course, you see several of them also in the US. And it'll be an interesting field to watch in the next, I would say, next couple of years, where the developments in these become extremely interesting. And then, two other trends will also drive this. Our ability to operate in markets that are thinner and are less liquid and more volatile also will increase, because you don't need a very large, very thick, or what you would call a high volume marketplace in which you need to operate. You can operate in thin markets if you have very good intelligence. And so the correlation between a highly liquid and very transparent marketplace like the US or the Israeli or any stock market that you take, the futures markets that help you hedge or take positions on these in a future sense, as well as the commodity markets and the OTC markets in FX, all of these are today well-developed marketplaces, and you're going to see an increasing interplay between these. Now, of course, this comes with enormous risk, because in the traditional models, you just needed to control one of these for you to be kind of managing the risk on that exposure at a time. But now you're going to have exposure in all these asset classes for a given fund. And I think managing that will require equal amount of intelligence and equal amount of processing. So I think it is these two areas that we will be seeing enormous developments. And I think the next several things that you're going to listen to are around developments in these. So with that, let me just wish you all the best for the rest of the sessions. And also, as I said, I'll be an interested participant and a watcher in how these technologies are harnessed, as well as how they are controlled from a regulatory and from a market operator sense. So with that, let me hand that over back to you, Yoav.
Great, thank you, Ramu. Great presentation. Thank you so much. So let's move over to the first company from Israel. The first one would be Data Science Group. And on behalf of them is presenting their CEO, Dr. Ilan Sasson. Ilan?
Oh yeah, thank you very much. I just want to share my screen. Just want to make sure that you can see my screen.
We can.
How about now?
No, now we see the.
Share, let me see.
Yeah.
Okay, I'm sorry about that.
Yeah.
Yeah, all right?
Yeah, now it works well. Yeah.
Yeah, great. Okay. Well, first of all, thanks for having me here. My name is Ilan. I'm the CEO and of the co-founder of Data Science Group. DSG is actually a global AI center of excellence based in Tel Aviv. And I think that today's session really much resonates with Ramu's presentation. And I really want to talk to you about how can we build trustworthy AI, okay? So it's really quite evident that AI system, and Ramu mentioned that, are gradually being, used to support human decision making. So, and actually, financial institutions are increasingly investing in AI and machine learning models, which are deployed across different line of business. Okay, signaling and algo trading is definitely one of them. So, while AI holds the promise of delivering valuable insights, broad adoption, even nowadays, of AI system relies heavily on the ability to trust their output. And trusting is a major, I would say, bottleneck when you want to actually deploy an AI system in a production environment. So human trust, if you see it in technology and not just in AI, is based on our understanding of how it works and our assessment of its safety and reliability. So I argue that trustworthy AI is about two equally important components, namely reliability and explainability of the AI models. And actually, in response to these industry challenges, but not just in financial market, but all financial verticals, but other verticals as well, we have been developing the Evolve, our AI-based solution, aiming to address those two, I would say, those two challenges. And I will be happy to showcase the platform afterward. But in today's session, I really want to talk about the fundamental and philosophy about trustable AI. Okay, so just briefly about DSG. I just want to do it as briefly as possible. So I would say this much: it was founded 6 years ago, but by myself and my partner, Dr. Gideon Rosenthal. So we have like two main divisions. One of them is the AI-enabled business solution, where we provide A to Z business AI-enabled and AI-driven solution to many customers. And we have also the division of the AI products, Evolve, which is actually Dr. Guido Zortali is heading this, has been heading this division. So we are a team of 30 data scientists. We have a lot of, we've been engaged in more than dozens, I would say, or I would say more than 50 different projects in diverse verticals. As for the team, just want to give you an idea. Well, we definitely have a focus on, oh, sorry about that. We have definitely have a focusing, we've been focusing on the healthcare and the finance. So that's the leadership. This is Gideon, Dr. Abdul Murabile, Dr. Goldman Neumann Wexler, Dr. Daniel Afterman. We are very proud to have Dr. Erna Berry, also known as Mr. Itek Israel, and Professor Kumel Sofer. So just to give you an idea about different verticals that we were engaged in, I think that what we bring to the table, a lot of understanding and fundamental understanding of the AI market in different verticals. But with that in mind, I want to move to our main, to today's session. So trustworthy AI, as I mentioned before, has two components. One of them is model explainability and interpretability. So let's see what is interpretability is defined in terms of AI. So the ability to explain how a model predicts an outcome based on the input, okay? And the input usually it's what we call the feature space. And when I refer to global and local, I mean global refer to the model level and local to a specific prediction. So more specifically, let's say if you are, if you want to see globally what are the most important feature, let's say in a credit scoring model, for example, salary, education, and so on, as opposed to why model did not approve John's loans request. So this is more on a local level. Secondly, and most importantly, is the degree to which a human can understand, okay, a human decision maker can understand the cause of the decision, why the model came to such a conclusion. And I think that when we understand why, what is interpretability, so we ask ourselves, why do we need explainability at all, right? So the idea is that in case where AI models are not transparent by design. So usually we say that they do not provide algorithmic transparency. So they are, in many cases, they are like black boxes, right? So, and when they are black boxes, generally model with, even with higher predictive accuracy, such as deep learning, tend to be harder to explain. So there is really a trade-off between explainability and I would say accuracy of the model. So the model that tend to be very accurate by design, they are not very transparent to the human decision maker. So what we need actually is a post-modeling explainability method, right? That can be applied as external techniques. And I think this is also a very trending topics now there. We call it XAI, which stands for explainable AI. So, and definitely regulation is part of it, right? So in highly regulated markets, such as even in the finance vertical. So I think that the GDPR, they have like the chapter 12 titled "The Right to Explanation." They have dedicated one chapter just for the right to explanation. That's really, I think, showcasing the importance of explainability when it comes to AI. Where we can see here, like you have like a black box model, and then actually when you want to unbox the black box, so it can give you some transparency of the model, and then a human decision can feel comfortable working with this model. Second, as I mentioned before, it's a model reliability. So what is reliability? So reliability defined as the automatic ongoing of AI monitoring in production environment. Okay, and we have to understand that once you deploy an AI driven application in production environment, you're going to experience some data set shifts, okay, which will cause degradation of the machine learning model over time. So AI system behavior is not governed just by the code, but also the model behavior is also governed by the data. So unlike traditional machine learning applications that assume that the data is sampled from a stationary distribution, we say that when we're dealing with real world data, such as financial data, data shift is the norm rather than exceptions. So academically speaking, we said data live in a non-stationary environment. So that's the nature of the reality. So what we want to do, we want to do it in an agnostic way. Okay, so we actually want to do AI performance management in an agnostic way. We don't really want to peer into the internal of the model. We want to do it as a black box. Okay. So secondly, why do we need reliability? Is because model and production data often mismatch in real-life setting, and that's given. That's not something that you can do a lot about it. And then in the real world, the feature, the variables, okay, that contribute to your prediction are often unstable and change over time, okay? And so there is like, there's like inconsistency between the old data that you trained your model on with the new fresh data. And it definitely will affect your model performance. So that's why we believe that data need ongoing maintenance. So this is what we are, when it comes to machine learning, we said changing anything changes everything. And you have to bear that in mind. Okay, so that's the evolve. And actually, if you have an existing data science pipeline, which is actually it's a multi-step process, starting with the data sources, doing some pre-processing and cleaning your data, and then you have like a clean modeling table, and you're going to your machine learning model. You come with prediction. What we said, what is missing, the missing link from that is the evolve. And the evolve actually will provide you both in R&D environment and production, and equally important in production environment, the monitoring for those data set shifts, and also explainability and interpretability, a method that will allow you to understand the model performance over time, but also to understand specific prediction, or maybe globally the most important feature that contribute to the model. So it comes with an API, okay, which is not just algorithmic a solution, but also with an AI. With user interface. I'll be more than happy to showcase later on. So just the benefit of explaining model, I just want to give you a very toy example. This is really based on a true story. So here we have like a classification model trying to classify, by the way, based on deep learning, trying to classify images of a husky and wolf. Okay, so here it said all of a sudden what you see a great model because you have only one mistake. And you are, you said, wow, this is the great model. Let's deploy it in the production environment. But then you should ask yourself, this husky was misclassified as a wolf, but why? So when you ask this question, you're gonna ask which areas, or more specifically, which features of the photo are the most significant for the classification. And when you do that, surprisingly enough, you'll find out that that's the one that was misclassified. And if you gray all those, I would say, the features that are related to this animal, and you get only the snow, but actually what you see, that the snow was the main contributor to classify wolves. So all of a sudden, you're gonna end up with the perfect snow detector, and not something that will actually will do a good classification between wolves and husky. So what we tend to say that the model is was trained on a biased data set because it was presented with a lot of images of snow as the background. And as a result, actually what happened, it picked the unimportant element in the data, which is the background. So the model perfectly tricks you, and it fits to this noisy and unimportant elements, and that's why we need explainability. Next, when we look at the benefit of reliability, which is the other component, so here we are, let's go to the real world, the trader world. So here you have like a trader performance in validation and test period until there's some data set shift. So if you look at your PLA, profit and loss, you see that you're doing quite well. But all of a sudden, you see some, I would say, performance dropping right here. And when you want to look at it and you want to examine what happening in that this is something that cannot be ignored, right? So if you want to really look at it, so all of a sudden, when you look at the different features that contribute to the prediction, right, all of a sudden you see some shifts, right? You see those shifts, all the density function changes between, let's say, this is feature number 1, this is feature number 2, this is feature number 3, but also you see some of those shifts in the probability distribution function between the validation and the test, meaning that we can attribute this, I would say, performance dropping to those shifts. So that's why it's very important, not just to be explainable, but also to be reliable over time. And with that in mind, I leave for you for QA, or if you would like, we can present the concept of what we do afterward. Thanks for attending.
So thank you, Ilan. Okay, so next we will have Lior Yogev from FundGuard. Lior, can you hear us? You with us?
Yeah, hey.
Yeah, thank you.
Thank you, Yoav, and thank you, everybody, for joining and for the opportunity to present FundGuard. Let me just share my screen here in the background. So today I'm going to tell you about FundGuard and share a short demo of what we do, which generally tells the best story. So FundGuard is a next generation platform for managing investment funds. And when we talk about investment funds, really we think about kind of mutual funds, hedge funds, insurance, pension, essentially anything that's an investment portfolio. Basically, we focus on the areas of fund administration and asset servicing. So all the middle and back office of fund operations, everything essentially after the trade happens. Myself and the team come with a rich background in the industry, many years servicing some of the leading fund administrators in the world, as well as asset managers and asset owners. You can see some of them here on the screen. And really seeing how archaic some of the workflows and technologies that are being used today to service many trillions of dollars in assets being managed by funds. So myself, prior to starting FundGuard, I was the head of North America for a company called Multifunds, really working again with many large global fund administrators, seeing the inefficiency that exists in fund operations. And then my co-founders, William Young, who's a very detailed industry expert, has worked with some of the largest banks in the space. And my friend for 25 years from Unit 8200, we built, I would say, in the 1990s, big data and data science systems before the whole world became big data. Yaniv, who was previously the head of R&D for Salesforce in Israel. Basically, we're trying to bring the world of asset servicing into the 2020s from a state where today there's essentially the backbone are very old, archaic systems that were built in the 1970s and 1980s, where the industry was very different than what it is today. Apart from a very strong industry expert team, we have investors and advisors from the industry, including Heidi Miller, who was previously the CEO of Custody and Securities Services for JP Morgan. She's on the board of HSBC, so someone who's very familiar with this world, along with other investors and advisors who are very engaged in the industry. So basically, the challenge that myself and the team have seen working with very large banks in this space is that the world is still being managed as though it's the 1980s in terms of technology that's still on-premise and batch-based, which makes it difficult for asset managers and portfolio managers to get real-time information about the risk in the books, about how much cash they have available for trade, and really takes a lot of manual effort in terms of managing funds. And in this day and age, ultimately, where the asset management industry has seen compressing margins for many years, and because of ETFs, because of increasing regulation, and we don't see that changing anytime soon, that really shines the spotlight on operational efficiency. And that's where FundGuard comes in to replace the backbone systems that are still predominantly on-premise and batch-based, don't support the volume of trades that exist in the world today. So at FundGuard, really what makes us unique as the system of records for servicing funds, I would say there are three things. One, we're the only core platform that's truly a native cloud as it relates to being real-time, as it relates to being highly available in the cloud. And we're digital from the core, which creates a lot of operational efficiencies for our customers in utilizing modern workflows, collaboration capabilities, modern APIs, and mobile access. And we're the leaders in data science in this space. And we're going to show you through the demo that I'm going to share a couple of examples where we are able to identify unstructured anomalies that large financial institutions today are finding it very difficult to identify those, and usually only see those once kind of the problems become quite big and more difficult to overcome. And we're using it also in terms of automating a lot of the process around exception management, investigation, and resolution. So kind of just one more thing around our go-to-market strategy before we dive into the demo. So when we looked into this space, you know, we kind of thought about a customer base that's highly regulated, and that makes them, you know, relatively conservative and slow to move. And we're looking for a wedge that would help us kind of provide value to customers quickly without replacing their core platforms. And that's where we ended up focusing on a strategy that we call shadow NAV, NAV for the net asset value of the funds, where a major global custodian had a major outage with their primary system a few years ago, where their system went down for a full week and they couldn't bring it up from disaster recovery. And as a result, basically that bank had to manually calculate the NAVs for more than 1,200 funds with using Excel essentially. And they made significant mistake because calculating the NAV for a complex global funds is, you know, not a rocket science, but it's a complex kind of engineering problem. And as a result, the SEC, the Securities and Exchange Commission in the US, came out with guidance to asset managers regarding their fiduciary responsibility for business continuity of the fund, which really elevated the need of asset managers and fund administrators to find affordable contingency NAV solutions to ensure BCP for their funds. So that's really kind of, you know, where FundGuard is today. We're providing a NAV contingency solution and a primary NAV solution for predominantly for mutual funds, ETFs, hedge funds, and separately managed accounts. But long-term, really the goal is to build an end-to-end platform that services funds anywhere in the world across all types of financial segments, including insurance, pension, real estate, and private equity. So without further ado, I'm gonna play a short 5-minute demo. And if you guys have any questions, happy to set up a follow-up meeting and discuss in more detail. You know what, I think I need to reshare my screen, sorry. Okay.
To access FundGuard, you go to fundguard.com, and from here I can simply click Login. I then give it my user and password, and I am into the application. The first screen that I am taken to is my inbox. So in my inbox, I'm provided with alerts, tasks, and insights that are moved directly to me as a user that I need to then act on. So in this example, I'm an administrator, say someone like JP Morgan, and I am servicing asset managers, Federated, Fidelity, Goldman, and Vanguard. You can also see that I've structured my view so I can look at things by, say, product, mutual fund and ETF, or by domicile, say, US or UK. And what I'm going to show you today is some of the abilities of FundGuard to work with alerts and to justify these exceptions. So the first one is a large manual trade, and I'd like to highlight here the collaboration between two users. So users can work together, push the item back and forth in order to justify provide, say, a backup or enter in some free text to justify an exception. The next one I'd like to highlight here is a large price movement. So this is an example of FundGuard's AI in action. So what FundGuard can do is, when in this case there's a price variation, 116 to 185, FundGuard can go out to a source, say redhat.com in this case, identify a story that Red Hat's being acquired, and then pull that story into the system for ease of justification and approval. So that's a really neat feature. The next thing I'd like to highlight is the irregular trade volume example. So in this case, FundGuard, there's no threshold, and FundGuard has identified an anomaly in the data. So we see that there's a spike of 87 trades today where the average has been 20 to 40 per day. So in this case, FundGuard provides you with a nice backup graph to provide you to back up the data that it found, and the machine learning kicks in. So as it starts to see this pattern, say this happens every month, well, the user can say this is an okay insight, and then FundGuard learns to not raise that insight, instead can focus on other types of anomalies. So those are 3 examples within my inbox. The next thing I'd like to show you is my dashboard. Here I can follow those same funds and those same products, and I can follow along on the assembly line. So you see, for example, that the daily accruals have happened, the capital has been loaded, the trades have loaded, and you get to see statuses around each step of the assembly line of the NAV production. I can see my exceptions, my insights, and I get key metrics around each item there. So if I then say select reconciliation, I can drill in to take a closer look at our reconciliation capabilities. Okay, for reconciliation, FundGuard provides deep reconciliation for things like position, NAV, trial balance, or outstanding shares, as well as market data, for example, security, prices, FX rates, and corporate actions. If I go from left to right, you can see the source data and the FundGuard data. And we compare each item, each data point in each line item. And if there's a breach, I see it right here, and I get key details over here on the right. The next thing I'd like to show you is the fund screen. So I can again look at my funds by the different breakout, but here I'm going to select all funds. So what this screen shows me is my real-time positional view. I can also look at my real-time tax lots, receivable payable, completely integrated in real-time trial balance, NAV, cash, and other activities as well. The screen provides me with, I can see my quantity, my cost, and my market value. And then I can also use the graphs here. They provide some great information, and I can use them to filter, say, on a certain fund. And I get to see my filters stack up here at the top. So I can add as many filters and sorting capabilities as I want directly on screen. Additionally, I can use the as of filter up here at the top, and I can select my fund view if I want to look at ABOR or IBOR or tax, all the different views supported by FundGuard. I can look at tags, I can look at accounting date, quick date picks for accounting date or knowledge date. On the right side here, I get a lot of great details. I can see the main details, my mark-to-market information, local base, my income, my interest, all there depending on the asset type. Additionally, I have the concept here of a related. So if I select related, I can see what is the last event that updated this position. I can see what tax lots there are. And if I select another security here, you can see that I can drop down and I can look at all the tax lots related to that security and then further navigate into that entity. The next thing I'd like to show you is trades. If I go to my trade screen, for example, here I can look at a timeline. And so that timeline can be by trade date or it could be by created at. And I can highlight a piece of the timeline and drill in further into that the activity during that timeline. So for example, here I went into a 3-minute window. I can then highlight a 2-minute window and then see the exact trades that were created or updated during that 2-minute time frame.
Okay, so thank you very much, everybody. And if you're in the fund administration space, kind of whether with an asset manager or bank, we'd love to continue the conversation. Thank you.
Thank you. Thank you so much, Lior. So I'm just reminding all the participants in the webinar now that you can ask questions with the Q&A part. So you can press the icon of the Q&A, ask questions, and our panelists can answer the questions that you have. So feel free to use it. Next, we have Yaron, the CEO of I Know First. Yaron, the stage is yours. Yaron, we can't hear you. You're on mute. Yeah.
Can you hear me now?
Yes.
Okay. Hello, Yoav. Thank you. I will, in the next 10 minutes, I will present I Know First. I will provide some examples, but feel free to contact us after the session if you would like to get more details about our solution. So we are an AI company. Our main solution is a predictive algorithm that produces daily predictions for the financial markets and identifies the most promising investment opportunities. We are utilizing artificial intelligence, more specifically machine learning, deep learning, artificial neural networks to predict the financial market. Our predictive algorithm is generating daily forecasts for over 10,500 assets from different asset classes, equities, commodities, currencies, interest rates, world indices, futures, with daily forecasts for different time frames. We are offering 18 time frames from the short-term forecast, mid-term forecast, and also the long-term forecast. This is a global solution. We are covering over 50 global stock exchanges, including the stock exchanges in the US, Canada, Europe, but also most of the stock exchanges in Asia, specifically Japan, Korea, Singapore, Australia, the 3 stock exchanges in China, Hong Kong, Thailand, Taiwan, India, and more. The brain behind the algorithm is Dr. Lipa Roitman from the Weizmann Institute of Science in Israel, one of the leading experts in the field of artificial intelligence, machine learning, and the combination between artificial neural networks and chaos theory. Dr. Roitman is leading our R&D team that's based on PhDs, AI and machine learning experts. We have math professors as part of the core team from Tel Aviv University, as well as IDF veterans, specifically from the intelligence units. The solution has received several awards, including from UBS and Entity Data in Japan. Basically, we are providing 2 solutions to our clients. We are working with clients, mainly banks, hedge funds, family offices, asset management firms from all over the world. And we are providing to them mainly 2 solutions. On one hand, we are providing the predictive algorithm as a decision supporting system that assisting them to identify opportunities in the market or to monitor their own portfolio. On the other end, we are also partnering with our clients. We are managing funds with our clients. We are developing different AI-powered investment products with our clients based on revenue share. So how we do it? Basically, our predictive algorithm is collecting everyday data from the entire financial market. We are adding the daily data to our database. We are managing database with historical data. And around the clock, the self-learning algorithm is learning from the new data that's coming all the time from the market, learning from the historical data. The predictive algorithm is identifying patterns in the market and generating forecasts for the near future and also for the long term. As a self-learning algorithm, the algorithm is also learning from the past predictions and learning from its own past successes and failures. We talked before about transparency. And one of the most interesting things about this predictive algorithm that basically it's not a black box. It's possible to receive the reasoning behind each forecast. Let's say that the algorithm identified Netflix as the best opportunity today. It's possible to go one step back and to identify the main contributors and to bring reasoning to each forecast. In terms of the technology, we are combining different AI approaches into one machine learning algorithm. The leading one is artificial neural networks. And the most interesting thing about this predictive algorithm is that each forecast comes with confidence level. The predictive algorithm is separating the predictable part from each stock exchange, let's say Tokyo Stock Exchange, and separating the predictable part, the predictable assets from the Tokyo Stock Exchange, from the unpredictable assets from the Tokyo Stock Exchange. And based on the most predictable assets, we are generating the daily prediction on the daily basis. Here we can see an example. The algorithm is generating an heat map for each particular stock exchange. In this example, we can see an example based on the US stock exchange. The green cells represents assets with positive forecast. The red cells represents assets with negative forecast. And besides the direct forecast that the predictive algorithm is generating for each asset, the algorithm is also conducting a ranking based on the expected return of each asset. So the best opportunities are going to be located right here on the top part of this heat map. And the assets that we should sell or short sell are going to be located at the bottom of each heat map. This is a long-short predictive algorithm. We can see here different indicators that the algorithm is generating every day. The first one is the direction, the signal. It's providing us indication of the predicted movement of each asset. The second one is the confidence level, the predictability. It varies between -1 and 1. And this is the Pearson correlation quality measure that's helping us to identify the most predictable assets every day. Let's look at some recent examples from the recent days. Here we can see an example of the 3-month forecast that the predictive algorithm was generating for the US stock exchange. We can see here the best or the top stock picks that the algorithm identified back then. We were talking about Netflix before. Here we can see the forecast for Netflix. So those 10 stocks were the best opportunities that the algorithm identified 3 months ago, basically. And we can see here the prediction also for the predicted movement of the index itself, the S&P 500. We have also forecast for the short term. For instance, here we can see 2 weeks forecast that the algorithm was generating and the best opportunities that the algorithm identified back then. As mentioned, this is a long-short algorithm. Sometimes the algorithm is predicting actually negative trend to the market. In this specific day, when the coronavirus started to affect the market, we started to see negative signals and negative forecast for the market. We can see the negative forecast for the S&P and the assets to short sell. In the very same way, we can predict based on different sectors. For instance, the tech sector. We can focus on the ETF universe. And we can also focus on different global stock exchanges. For instance, Tokyo Stock Exchange. We can see here a recent example based on the Tokyo Stock Exchange stocks. Australia, India, Hong Kong, Shanghai, China, Shenzhen, China, and Europe, Canada, and basically most of the stock exchanges around the globe. So this is our product. Feel free to talk with us in the B2B meetings later on, or to shoot us questions by using the chat. Thank you very much.
Thank you so much, Yaron. So again, I'm reminding you to try to use the Q&A part. Next, we have Boaz Yaari from ShareGain. So Boaz, the floor is yours. Boaz is the CEO of ShareGain.
Thanks, Yoav. Let me just share the screen with you. Okay, thanks everybody. Let me see just my screen. Okay. Here we go. We've got the video, we've got the screen, we can start. So I'm the last one. By the way, thank you, Yoav. Thank you for the Israeli embassies for hosting this event, and thank you everybody for participating. My name is Boaz Yaari. I'm the CEO and founder of ShareGain. And I'm the last one, so I'll try to make it short and succinct so we can go to the Q&A. Let's talk, before we start talking about ShareGain, let's firstly talk about the financial services as a whole and the place that we're in right now. So as we know, Hurricane COVID hit financial services really hard. Probably ended more than a decade of a long bull market with low volatility and high returns. But this reality has now changed, and we're getting into a new era of much higher volatility, less uncertainty, lower returns, and compressed margin, only by the fact that we've seen from an asset management and wealth management perspective, we're seeing a lot of competition that's coming in from passive investing like ETF, from fee-free share trading platforms. We're seeing increasing regulatory cost, increasing IT cost, and all of that is effectively compressing margin for financial institutions. Now more than ever, it's crucial to generate new sources of income on existing assets. But many financial institutions, while looking at new business models and new revenue streams, are not aware of something that has been there for almost 60 years. a $2 billion industry called securities lending. What is securities lending? It's very simple. Every owner of stocks, of bonds, of ETF has the right to rent it out and receive for that rent, lending rates. And that new source of income, which we call rent or lending revenues, are effectively on top of any other income streams like appreciation of the assets and dividends of coupons. So effectively, you're generating a new source of income on assets you already own. Now, this industry hasn't been new. It's been there for more than 60 years, whereby big financial institutions have been banking billions out of it. Why would anyone actually want to borrow securities? It's very simple. Every strategy that involves short selling requires borrowing against it, but not necessarily short selling for the benefit of a depreciation of the assets. It's moreover, every strategy that involves market making, sometimes using securities lending for underlying as derivatives, convertible bond strategies and so on, requires borrowing against it. And as I said, this is more than a $2 trillion industry that's been there for 60 years. The issues with that thing is that securities lending has been very much a very opaque, closed system, very complex, very underutilized, whereby about 30-35% of financial institutions globally are doing it. And 65% of financial institutions, and I call them small to medium financial institutions, have been shut out or underserved from this ecosystem. Why have they been underserved and shut out? Because there's a lot of barriers to entry. It's still an OTC market. It's very opaque in terms of supply and pricing. It's a lot of manual processes, and it's driven by systems that were probably designed 25 to 30 years ago. So what does ShareGain bring to the table? Well, at ShareGain, we've basically brought securities lending to the digital age. Forget about SaaS, forget about software. We brought you an end-to-end solution, like outsourcing a securities lending line of business to a solution that does everything for you, A to Z, nuts and bolts. We give you the technology to deploy internally, so that you wouldn't need any IT budget to effectively build a securities lending infrastructure. And then you can offer that securities lending as a service, as a feature to your underlying clients, whether you are a private bank or an online broker or a custodian or an asset manager. Whoever you are, as long as you're a financial service that is connected to the global ecosystem, we can connect you. We connect to your custodians. We give you the internal tech to deploy internally, but moreover, we also do the entire lending for you. We facilitate it. We manage the life cycle of the loans. We manage recalls, returns, payments, income processing, everything for you. We call it set and forget. You set the lending terms, we do everything for you. We also integrate, we've built a very robust, being Israeli technology, we understand that most financial institutions, one of the main barriers are effectively their legacy systems. So we spend a lot of time to build a very robust integration layer. And that integration layer effectively sits in an overlay on your existing stack. So you don't need to build anything into or develop anything into your internal processes. And that integration layer enables us to connect with your system in any time between, call it 6 to 10 weeks. Also, how do we actually make money? And this is a key thing. We believe in aligning our interests with you. So no IT budget, no new project budget, no problem. We don't charge any management fees. We don't charge any fixed fees. We don't charge any onboarding fees. We charge one fee and one fee only, which is a success fee. If you don't lend, you don't pay. And if you do lend, we take on average about 20% of your lending revenues. Simple as that. Now, if you think about, what does an Israeli tech company brings to the table? Well, it brings, I think, the best of two worlds. It brings Israeli tech talent. All of our technology is proprietary and is developed in Israel. And we bring that and we combine it with the London capital markets expertise to generate the best of two worlds. We have to date raised about $17 million we're VC backed, about 40 people. Our clients are mainly, we're obviously—
Sorry to interrupt you, just the slides aren't moving. We can't see, the audience can't see the slides moving.
Which slide are you now seeing?
We just saw the first one that says share gain, expect more from your securities.
Interesting.
Yeah,
and
now it works. Okay.
Can you see the slides now?
Yeah.
Okay. So no slide has moved. Okay. Okay. So as I said earlier, we're 40 people. We are sorry, we're 40 people based in the UK and in Israel, servicing our clients, and our clients are online brokers, custodial banks, asset managers. All of them have either had wanted to engage in securities lending, but didn't want to open it as a line of business, and wanted it as a feature that they can then offer to their underlying clients. And I want to leave something with you. We can talk about it obviously in the Q&A, and feel free to reach out to us. I want to leave it something for you as a thought for the afterwards. From a securities lending perspective, in terms of value of equities from a regional perspective, America is about 40 trillion, and the securities are on loan about 1.2 billion. EMEA, it's about 20 billion in terms of market valuation, sorry, 20 trillion. And securities on loan are, as of end of 2019, about half a trillion. But in Asia, was about 30 trillion in terms of market valuation, global market valuation. Securities lending as a region is the smallest. Less than 300 billion is on loan. Why? Because most financial institutions haven't been able yet to connect, haven't seen it as a line of business, didn't have the right technology, the right expertise, and the right knowledge to actually deliver securities lending as a feature to the underlying clients without needing to have a lot of CapEx and OpEx to generate it. And we see Asia as the fastest growing market. And from a securities lending perspective, we wouldn't be surprised if in 2-3 years' time, the market will be 2 or 3 folds bigger, and that will just equate the relativeness versus other regions. So there's great potential in securities lending in Asia, and we're here to help you if you want to make that as a feature to your clients. Thank you.
Great, thank you, Boaz, so much. And last but not least, we have Bond IT, Itai and Andrew. Guys, the stage is yours.
Thank you, Yoav. Can you see my screen?
I can't. I can hear you, but I can't see your screen. Now I can, yeah.
Excellent. And Itai, would you like to lead off? Did we lose Itai?
I think we did, so...
So let me jump in. I will do a live demo that we will conclude well within the 10 minutes so everyone can get to the Q&A. So as some of you may be familiar with the renowned Weitzman Institute, that is where Bond IT began. We have our core team of machine learning algorithm specialists and data scientists from the Weitzman Institute who over the years have built purpose-built for fixed income the technology that you are about to see. So I'm going to construct a live portfolio, and we're going to touch on some of the things that we've already discussed today, such as Ramu highlighted, synthesizing trading signals, harnessing data, and really using the technology to drive real-time fixed income solutions. So you can pick a portfolio name and investment amount, and really any of this can be inputted by the user to their desires. All of the data is fit per user specifications. We are data agnostic. So what you're seeing is either proprietary, alternative, or market-based data. Here we can pick a 10 million portfolio with a universe of really any amount of ISINs that are in existence. we can then look to the optimization, and this is where we're harnessing the machine learning, and there's a wide variety of optimizations. We can work through maximizing yield to worst, minimizing duration, maximizing rating, just as a few examples. If we pick maximize yield of the portfolio, we have portfolio targets, which here we can skip since we're maximizing yield, but focus on portfolio credit rating and bring the credit rating up to BBB+. Now, we can actually construct, on top of the optimization, a cash flow ladder for any number of years with any start date that we desire. Let's pick Jan 1st of 2021. Any frequency down to monthly. Let's pick semi-annual. And we can even create bespoke cash flows. So we could change any of these amounts if we desired. At the bond level, we have a number of workflows that we can go through. Again, with the ability to harness really any trading signal that we desire, downgrade probabilities, probabilities of default. Here we see ratings breakdowns. We can take out anything below BB. We can set weightings of thresholds, minimum inclusions. We can go through quite a few other workflows with the same idea. I'll go through these quickly so that we can all get to the Q&A, but you get the idea of the detail we can go down to. We can do multi-currency, we could do multiple countries of issuance, multiple coupon types, set min-max weightings. We can even look at market-based data, all in real time, all API first, and then we can generate the portfolio. Bond IT can integrate tens of thousands of portfolios, and you can monitor and analyze them all from this page here. We would be able to see any updates to those portfolios, share them throughout the organization to permissioned users. We've done that with existing clients. You see in the top right here, this portfolio that we constructed is already done. So with stunning speed, the algorithms have been able to optimize a portfolio on the investment amount of 10 million to an optimized yield of 6.40, matching our ratings target with a duration of only 2.87 years. Now, we have the cash flow graph here. As you remember, we actually set up a cash flow ladder. We could download the entire cash flow graph into Excel to slice and dice it. But if we go all the way down to the bottom, we can see here that matching the constraints, we have cash flow requirements as desired per each period. Going back up above here, we have risk and analytics. Any of this can be exported via PDF, can all be created bespoke for reporting and analytics requirements per client. And then finally, the portfolio. We could rebalance it just as easily if we wanted. There's quite a bit more functionality we're excited to show you during the Q&A, but I'll pause there and turn it back over for the sake of time.
Andrew, you're done?
Yes.
Okay, great.
Yes.
So thank you so much for the participation, everyone. 1 second, let me share with you my screen. So thank everybody from all over APAC for participating. Thank you for our speakers, the Israeli Securities Authority, Data Science Group, Ramo and Anat. And we encourage you participants that if you have any interest to talk with any of the speakers today, the Israeli companies or maybe the Israeli Securities Authority, then don't hesitate to contact your local economic and trade mission. As I mentioned at the beginning, these are the main ones. So so be in touch with them, and thanks a lot. That's it for today.
Thank you.